Steel prices move fast. Budget slip, margin shrink, project stall. But this isn't random. Steel prices follow patterns. And when you understand them, you don't just survive the swings, you use them to your advantage. So what drives these price swings? Let's break it down. Everything starts with the raw stuff, iron ore and coal. These are the backbone of steel production. When their prices rise, steel mills pay more. And when mills pay more, guess who pays next? Yep, you, the buyer. Simple cause and effect. But it's not just about the mines. Picture this. China announces a massive infrastructure push, or EV production doubles in Europe. What happens? Everyone rushes to buy steel. And when demand floods the market, prices don't just rise, they surge. You're not just competing locally anymore. You're part of a global bidding war. Add in export bans, fuel hikes, and delayed shipments, and the picture gets messier. In 2021, container freight from China to India jumped 5 times due to port congestion. Result: steel deliveries slowed and prices surged. One stuck vessel can delay a project and inflate your costs overnight. So what can you actually do? Smart buyers don't just track steel prices, they anticipate them. Here's how. Forecast with your supplier. Ask them for trend data. Demand transparency. The good ones will share. Lock rates when prices dip. Think of it like stock trading. Buy low, secure supply, and sleep better. Don't overpay for every component. A seat frame and a crash bar don't need the same steel. Use premium where it matters. Optimize elsewhere. Steel prices will rise and fall. That won't change. But your ability to handle them, that's where the game changes. With the right partner, better planning, and smarter sourcing, you stop chasing the market and start staying ahead of it. Grow Ever Steel, built for what's next.